Hey everyone, my name is Kin, Chief Business Development Officer of Tomo Chain. Today I am your host for the latest panel discussion in our Defining DeFi series, where we're going to be focusing on demystifying synthetic assets in the blockchain space, along with some key experts driving these innovations. So before I introduce our panelists, let's give a little bit of a primer for what synthetic assets actually are. So a synthetic asset really refers to a financial instrument that represents a real asset. So the simplest example that I can give you is if you think of in the blockchain space, a stablecoin USDT. It's the most common trading pair that I'm sure we've all used on an exchange at one point or the other. And when we trade USDT on an exchange, we treat it like it's the US dollar, but it's not really the US dollar. As in this case, there's a centralized business that's really holding custody of the US dollar itself. And then they basically issue USDT based on the reserves. So we get exposure to the dollar without actually owning it. And that's just a simple example, one example of what a synthetic asset is. And along with our amazing panelists, we're going to be diving into many more examples of what synthetic assets can actually represent. So along with that are our panelists from Ramp DeFi, Linear Finance, Unbound, and Box Mining. And I'm sure they're going to shed a lot of really amazing light on this topic. So with that, let me introduce you to our panelists. And so first, first up, Lawrence, would you like to give an introduction to yourself and to your project?
Sure. Hi, everyone. My name is Lawrence, and I'm the project lead for MDFi. Just a quick introduction about myself. I actually started in traditional finance for 4 to 5 years in the private banking and the investment banking space. Subsequently, from there, I moved into a blockchain project that was in 2018 called IOST. And I spent 2 years in IOST overseeing the international business operations, built up the ecosystem, and subsequently in late 2019, I started working alongside my co-founders on RemDeFi. And what is RemDeFi? RemDeFi is really a liquid staking derivatives project. So essentially, the core idea behind RemDeFi is that we allow users to stake their assets, keep it in staking, while at the same time allowing them to collateralize these assets into a stablecoin that can be used for a variety of purposes. They can exchange the stablecoin for USDT and bring it to, say, Binance or Huobi for trading, while at the same time, their assets, the original portfolio, is still owned by them, and they can still receive staking rewards from this portfolio. So yeah, that's a quick overview about RemDeFi, and hopefully across the session, I can share more with you about our project.
Cool, Lawrence. Awesome. Kevin, you're up.
Yeah, hi everybody. I'm Kevin. I'm one of the co-founders of Linear Finance. Just a little bit of background on myself. I actually started my career in Silicon Valley in traditional finance. I did tech M&A for a number of years before subsequently moving to going to business school. And then I've been out here in Asia for the last 13 odd years, working on collateralized debt pools for a number of the bulge bracket banks. And then subsequently working on alternative assets and Mirai Asset global investments here in Hong Kong. In terms of crypto, I actually started my crypto career as a miner. So I was essentially mining Bitcoin as well as a number of altcoins using GPUs and FPGAs, and it was quite active in the FPGA community working on the development of Bitstreams. Okay. For DeFi, I've been investing in DeFi for the last 2 years. Started Linear Finance with my other co-founder, Dre Ng, out here. And essentially, what is Linear Finance? We allow users to stake into our system, okay, into our protocol. And we're essentially a decentralized cross-chain compatible protocol. And the users can stake their coins, build our liquid LUSD, and then subsequently use that to purchase synthetic assets on our exchange. So over the last few months, we've been working on the protocol, and hopefully we'll launch within the next month or so. And primarily, we've been putting a lot of emphasis on the type of assets that we're looking to put onto our exchange. So it will be things like spot exposures into digital currencies, as well as a lot of what we call digital traded indexes, things that we're building that users will not be able to, hopefully will not be able to find on other exchanges.
Cool, man. Very cool. Tarun,
Hey,
tell us
hi
about
guys.
yourself.
Okay, no problem. Hi guys. Okay, I'm Tarun Jaswani. I'm the founder of Unbound Finance, and my background is I'm a telecom engineer with exposure to ad networks and VR before. I've been part of the blockchain space for last 4 years, which mainly included a little bit of blockchain, smart contract coding, investing in different projects, and basically researching till you find an idea worth getting started with. And with that in mind, we started Unbound Finance, a passionate project that we're trying to solve the problem of liquidation in the space. So we are building the derivative layer on the MM. So what we do is we lock up a liquidity pool token to give you a stable coin. And the best part about the whole ecosystem is that is the first collateralization where we do not have to worry about liquidations. So they are liquidation-free debt position, I guess. First time in the space.
Mm.
Right.
Nice, Tarun. Michael, welcome.
So I'll give a short introduction. So for me, I started off my crypto just like mining, just like Kevin over here. So all the way back when GPU was still possible, I kind of dabbled in a lot of mining. Then coming up to right before the bull run 2017, I decided to make a channel called Box Mining. I thought, oh, maybe we can share some of this knowledge, and that was super well received. So we have like around 216,000 subscribers right now on the channel. So we've been kind of discussing a lot, building that community up. Personally, I've been very heavily invested in the space. It's my primary area of investment right now. So I dabble a lot into these projects. I also analyze a lot of the trends that's going on. So for this whole DeFi space, and I think I individually talk to every one of you guys here. So that goes to show we're all friends here, and really appreciate being on this panel as well.
Awesome, Michael. No, really happy to have you as well. Great. So what we're going to do is we're going to dive into the questions first for our panelists. And I'm sure it's going to be quite interesting here. So broad question. First question for anyone is, and for everyone, why are synthetic assets important to our space? Broad question, but why are synthetic assets important to our space?
Great.
Do you want me to take this? Like, can I take one angle from the retail perspective?
Of course.
I'll just start this. So, so I have the perfect response to this, which is that, like you start off with USDT, which is like absolutely crucial, right? Everyone needs exposure to the US dollar, and you highlighted a very important point, right? It's like all of us in crypto believe USDT is worth $1, but if you go to like the Bank of America or something, they just laugh at you like, hey, you want to deposit some USDT? That's not real money, right? But it's real for us, which is very interesting because in crypto, we need tools like USDT. And I had a very, very interesting relationship with USDT as well, because when I started a channel, we're all very concerned if something like this is actually backed by the US dollar, and can we eventually redeem it, or will it just become nothing at some point of time? And it's kind of interesting because a lot of people try to fight the use case of these stable coins, but in fact, we realize with trading that people need a way to have access to fiat, right? As a trader, you need to be able to move in and out of crypto, right? And this is kind of absolutely vital. So initially, before I thought, some people were saying, let's fight it, don't get USDT, it's centralized, it's not good. But I think the solution rather is that we need more and more synthetic assets that kind of represent real world assets on the blockchain. I think this is kind of key because at the end of the day, we can't abolish trading altogether, and all traders need a way to have exposure to some sort of fiat asset or some sort of asset that's like oil or something crazy like that, right? So I feel like this is kind of my perspective right now, where the more we kind of understand and have built infrastructure for more synthetic assets, that's going to offer more traders more options to have. And I think that's the power of it. So having more representations of these US dollar assets or renminbi assets or Australian dollar assets or something like that, I think that's where traders need and want right now.
Okay, Michael, great explanation. But what if I say that I don't consider USDT as a synthetic asset at all, actually, right? So let me tell you why I'm feeling that, and maybe if you guys could collaborate or contradict me. See, we are actually based out of blockchain, which is pretty different than traditional financial systems. But still, we are borrowing definitions from the traditional space to define assets in this space. The reason I say this is, when you talk about traditional markets, a synthetic asset would be something that would mimic the price exposure of the asset it's trying to give you exposure to, right? So you could have options, swaps, or maybe the futures which go about it, right? But what happened in the blockchain space? What we do is we take our decentralized assets, we lock them up, and then we are free to do whatever we want with it. Actually, we either can maybe mint UETH, or when I say UETH, that's our unbound ETH. That's the reason I say that, which means that our own asset, which is synthesized in different fashion. A WBTC could be a synthetic asset in our world. But when it comes to USDT, I think that's completely different. I think why would you say that they're backed by a dollar when they're not actually, right? That's just a starting point. So when I say that a synthetic asset in this world could have two meanings, you could either mimic assets of this world or try to, do a price kind of collateral with something in traditional markets. So for me, I think USDT is not a synthetic asset. It's completely different. It's a new asset at all. And whether it's backed by a dollar or not, that we all need to see. So that's my point of view.
And just a very quick response to that. I think I definitely think setting that definition aside, and I think the key difference here is centralized versus decentralized, right? So USDT, they claim it's one-to-one backed. There's basically no way for us to check. They just say, yeah, it's there somehow. But for other assets, like say, for example, DAI, you can actually see how much Ethereum is backing behind it. So it would be a decentralized way of backing it. And I think that's the same with Unbound as well. You see what the assets, the on-chain assets there. So I think, it depends on what you want to name it, but I definitely say, there should be a distinction between a decentralized kind of, stable asset or synthetic asset versus a centralized variant of that.
I think Michael also makes another good point, and a big point about giving people access, right? So if you look at certain assets, even in the old traditional world, for something, say, like copper, a long time ago, it's actually, for a retail client, it's actually very difficult to get exposure to copper. You either have to have institutional connection, most likely need to post collateral. But nowadays, because of synthetic assets in the traditional world, you can actually go ahead and get access to copper. So the ability to go essentially mimic using synthetics to mimic price of any type of asset in the world opens up a whole new market for all of us that are essentially in this space.
Yeah, I think I would agree with that. I think what synthetic assets offer, especially for us in the current stage of crypto, is options, right? Like there's so many new options that traders now have. If we look at stablecoin, it started with USDT, but now DAI came up, and then there's different stablecoins, meta stablecoins that came up. So now users actually have a lot more options to create stability in the markets, using all these different stablecoins, and then they have different investment options, assets that's able to track something that's totally almost disconnected in the real world, but we can track that and create that sort of market over here in crypto. I think that's really impressive and really powerful. That sort of innovation that's happening in crypto right now for us. I think 2017 until today really focused a lot about infrastructure, about creating blockchains, platforms to develop on. And now I think we are rolling to a space where actually the infrastructure is available, and we are building new products for people to participate in. And I think that's when things really can pick up from here.
Totally agreed, Lawrence, because it's pretty win-win, man. First of all, what happens is for our decentralized assets, we're getting a use case. When you lock up a decentralized asset and then actually mint a copper-backed derivative, that's a win-win, because now our own ETH or BTC has having a use case of a collateral. And so, of course, that's a win-win for us. But of course, win-win for any markets that we touch. This means there is new liquidity event for any of these, new class of assets which is coming in. If it's a Tesla stock, which I can own being in India, using my BTC, that's a win-win actually for Tesla as for me.
Yeah, and I actually think for synthetic assets, where we currently are in this space is that we're still actually in the beginning, right? You're looking at things like futures, forwards, options, right? But there's a whole new set above that, things like total return swaps, credit default swaps. Once those are in and we have the risk management protocols in there and the people can actually assess how to price risk, then all those tools are actually available to investors, and you're actually able to use that and actually broaden basically your portfolio management at the end of the day. And we just don't, I mean, I think we'll eventually get there. But right now, I think we're still very at the beginning stages of this.
Okay.
Oh, excellent. So this is actually a great broad kind of perspective of what synthetic assets can represent, and kind of, so I guess maybe what we can do is dive a little bit more into what are the actual areas of innovation that all of you are seeing in synthetic assets, and each of you are kind of focusing on different aspects as well. So as we dive kind of deeper, starting from that USDT, kind of diving deeper into this, what are you guys seeing?
Yeah, I think at least from my side, I see that this wave of DeFi really has brought quite a lot of innovations. I think of course Uniswap started it all, right? Where farms, etc. All of these things kind of sprung up from there. But I do see in a sense a class of specific financial services in synthetic assets derivatives that's I think starting to become a bit more prominent. Not just in a sense trying to replicate different say farming products, but actually targeting to create specific investment options for users. At least for our project like Ramp DeFi, we focus on liquid staking. So basically allowing users to create options. How can you still retain your original portfolio of assets, still receive staking rewards and extract extra capital at the same time? So we don't just say you have to allocate your capital into A or into B. Just allocate it into something, and from there create a derivative that can allow you to invest it even more off the same base of capital. So that's actually in a sense leveraging on capital that you have already invested. So that's the part where we are focusing on. But of course, there's so many opportunities in the space right now, and I think linear finance is actually targeting a different part of the industry and creating something really interesting.
Terrific. Okay, terrific, man. That's great.
Yeah, I think for ourselves at Linear, we try to keep things rather simple. We're trying to focus more on providing portfolio exposures, I would say exotic exposures to retail clients or to retail crypto users, because it's actually quite simple to understand. And the fact that we actually have a collateral debt pool which actually serves as a counterparty to our traders means that we can essentially go ahead and create whatever we want. And I think we'll take the liberty of this to go ahead and be a bit more creative. So we're looking at different types of either portfolio sets within crypto, as well as some real world assets, indexes, to go ahead and do that. But I think for us, we're starting to focus more and more. We're going to start focusing more on research. So, it's going to be to differentiate ourselves. We're going to start looking into things like more active management portfolios. So instead of just doing a simple, come to us and buy a CFI or DeFi index, which is equal weighted or market weighted, I think I can find that anywhere. But what we'll do is we'll get researchers to figure out the right type of portfolio mix and just actually try to generate some alpha for people. And I think that those types of products and the fact that we can actually go ahead and create this on a synthetic basis gives us quite a lot of positive momentum and advantage going forward.
Perfect. Okay, great, guys. Second, I think when you say innovation in this space, I think what will happen is you need to divide the innovations in two buckets from the way I see it. One is outside the ecosystem, which will be regulations, right? And so when we saw even a centralized exchange like FTX listing those Amazon or fractions shares on their exchange for the whole ecosystem to trade, I thought that was a decent innovation because they must have solved some regulation, hoops to do that actually, right? So for me, that was one decent innovations. And then there could be innovation which happened within the ecosystem, where some project like UMA, which I really like, right? they would try to decentralize the locking mechanism so that anybody can lock and generate the synthetic assets, right? But I think the real one, of course, as at Unbound, what we really feel about synthetic assets, if you need to think of real innovation, you need to figure out how are these synthetic assets come into existence, right? In this blockchain space. So for that to happen, what happens is you would bring your decentralized asset, then you would lock them in smart contracts, and then you would price them with either oracles or price feed to then mimic the price of anything that you want to underwrite it with, actually, right? So for that to happen, we thought there was a major hassle or major issue of scaling the system, is because what you want to lock in smart contracts, that's very volatile, right? Which means if you lock on your WBTC or BTC or lock up your Ethereum or Link or any of the tokens to then maybe mint gold tokens, actually, right? That's amazing. Gold tokens will remain stable, but what happened to your asset there, right? These assets move quite a bit, which leads to liquidations. And I think that was a major challenge. And that's the reason we launched Unbound, because we thought with Unbound, we can solve the problem of liquidation. First time we could lock up a new class of asset called liquidity pool tokens, which you could offer without any liquidations. So I thought, I don't know if you can call it, but I think that was an innovation which we're very happy about.
So coming from, okay, so I came from a very skeptical perspective. All right, so when someone first talked to me about DAI, so this is a stable coin that's backed by Ethereum. So it's overly collateralized. So basically, for every DAI issued, supposedly there's $2.5 dollars of Ethereum worth of Ethereum sitting in a vault somewhere, which is great. But I came from a very skeptical perspective because I've seen how volatile Ethereum can get. Right. So I've been through that 2017 flash crash where Ethereum flash crashed on Coinbase to $0, right? Like to nothing. It's worthless now. So I'm always I've acknowledged that the power of Ethereum and DeFi is such that we saw we can prove that the Ethereum is there, but I was very skeptical of, okay, can we really use that Ethereum as some form of real collateral if Ethereum prices are so volatile? The good news is that throughout the last 3 years, we've seen more and more price stability, and we've seen better ways to have data feeds for Ethereum pricing as well. So even today, I think, as I speak, there was a very big dip for Ethereum prices on Bybit. It dropped from $600 to $500 within like a half an hour period, and then it went up again. So it's one of those situations where this is where accurate price feeds are important, because it only happened in one particular exchange or one particular pair. But if you use that, oops, you might have been liquidated, etc. Right? So I think a few things have been improving over time. That's leading to more and more confidence into DeFi, and I think this is where something I didn't really realize at the start with all this whole DeFi business is that everyone's playing a small part, but when it combines together, it becomes very powerful. So all of a sudden, yes, we can collateralize ETH and generate the DAI coin. And now with DAI, you can use DAI to go farm or to provide liquidity to something, and then you can lock that up. And then maybe with Lawrence's stuff, you can unlock some other tokens from different chains, combine that together, bring that liquidity. So it's all about power, right? All of a sudden, I'm given a huge new set of tools. And this is previously, I think for general public, this is something that's not within reach, right? Like say if I'm a gold bug and I hold a bunch of gold and I put it into my vaults, like what good does it do, right? It does nothing, right? There's a huge chunk of gold, I have a huge chunk of wealth, but it just sits there collecting dust. But now in DeFi, yes, we can have all these different coins, and all of a sudden now we can use that as collateral, move that over, get some USD out, borrow it, lend it, whatever. But you can also start generating money on it. And it's like, it's all a lot of power. Obviously, with a lot of power comes a lot of potential for exploits. And I think that's where we're at now, where we're trying to make sure things cannot be exploited. But I feel like being able to kind of like generate more and more wealth from a single pool of wealth and just getting more of that, I think that's a lot of power right there. And yes, I know there's still problems with that, but I think the power of a smart contract, someone was very critical, a lawyer coming into the space and say, smart contracts are neither smart nor are they contracts. They're actually not legally binding, but we know from the code perspective exactly how this kind of contract, this program will behave. And we know, like, yes, we can save it up, we can put in this vault, and we know the conditions of which we get liquidated and the conditions of which we can extract the loan from it. And I think there's a certain beauty to that right there, where now we have more and more things to play with. So our goal literally doesn't sit there and collect dust.
True. Hey, Mike, just quickly building on that point of yours, smart contracts are not legally binding, right? So I thought, if the smart contract do what they do, actually, they don't need to be legally binding, right? You don't need to trust. We trust in code, isn't it?
Yeah,
So,
that's pretty much it. That's pretty much it. In code, we trust. Yeah, like legal procedures take too long. Code, right? It just runs.
As far as all this, what we're doing is reach a local public, or a normal guy. I think it's pretty too far at the moment, right? We need to build better bridges, a better system in place for them to come and use it. However, you see this yield farming or whatever DeFi is happening, it's limited to pretty small space, especially I think, though everything is open actually. But the difficulty and actually, mind space to understand it and the space at it which changes, I think it makes it a little difficult for initial to mass adoption to come. But, I think what we're doing, I really feel is pretty substantial.
There's an incredible amount of, I guess, what you guys have also been pointing out is that there's a lot of malleability in terms of the tokens that we hold. There's more utility. It's giving us exposure to assets that the traditional world wouldn't normally get access to, and that's at a global scale. We're not really locked into any one region at all. We are, in effect, unbound, right? In that way. Obviously, there are, pun intended in some ways, there's obviously, regulations that are at work here, new forms of regulations that are being formed. And I think that what kind of leads into the next question here in terms of what do each of you see as some of the key challenges for the synthetic asset space in blockchain today? And, we can talk about basically how it's used, again, regulations or anything else that's kind of maybe a block in the path towards kind of achieving the goals that each of you have set in mind.
Great. I think I would like to go first here, actually, simply because, what we really felt about it was lacking. We started building around it. Right? Because I really feel, if we can convince our own people in the ecosystem to start locking up more value, we could see a lot more exposure happening, I guess. And that was the reason because, Mike brought up DAI, pretty in the last answer, actually. And DAI is pretty amazing revolution, I guess. But what happens is that it's so artificially pegged to be dollar that it needs to be pegged to the dollar, that it does not care if liquidation happens for its own people, and they still want to be pegged. I think for me, that is the major issue, especially when you talk about stable coins or any other assets that we still try to mimic from the traditional side of business instead of innovating of our own, actually, right? So, as you said, right, I think liquidations of these assets which get locked, we see the TVL, right, the total value locked, but whether it's Aave or Compound or any of these assets, right, the problem of liquidation, I think, prevents a lot of these adoption to happen. I think that we thought was a major issue. And that's the reason we found out that, we went after liquidity pool tokens, which are amazing assets to get locked without getting liquidated. I think that's what Unbound was passionate about. And that's why I'm trying to build something around it.
In terms of kind of the challenges going forward, I think for all of us, our space is quite young. And I think we've gone through a lot in terms of things like security, things like hacks. But if you guys look at the amount of TVL that's locked up, I think we're around $10 billion worth of TVL locked up. It's not really $10 billion worth of actual value, right? It's things that have been deposited. LP tokens have been folded over many times into many contracts, right? And we haven't gone through a phase where something has actually really messed up or something has gone wrong with a smart contract, and something catastrophic has happened. And I think until we get to that point and something like that actually happens and we actually get ourselves through it, the space is only going to be really limited, I think, to the DeFi users that we have right now. And I think other people looking in, people are starting to get into crypto, they're going to look for that experience before they actually start dumping into real money and coming into our space. And that's just something I think it takes time. And knock on wood, something catastrophic doesn't happen in the space. But ultimately, I think that we probably will need to go through it 1 or 2 times before we actually build the credibility to actually attract new users within DeFi.
Yeah, I agree, and I think one key thing that I would say while at least for us while we are building our project is always about edge cases and education. So I think firstly, education. I would say in the DeFi space, there's a lot of new innovation, right? So a lot of times we never really know what we are buying into. So like even like something in the more simpler in the sense, like UFOMs, right? I myself have gotten burned by impermanent losses in a really bad way. I'm sure most of the panelists here as well as the audience probably have that happen to them. Yeah. So and that's really like even would be considered one of the more basic products, right? Like more common products available. And, we are seeing all sorts of, interesting and different things that's being built out. It's a good thing because innovation always, create opportunities. But and of course, as users, especially on the retail side, I think there has to be a lot of education. And I think that it sort of brings it into edge cases as well. I think we have seen a lot of security exploits, partially also because all these products are so new that the edge cases, things that's very long tail, far out, have not been considered, and someone managed to find it, and that results in certain exploits. So I think I would say that would be one of the key challenges to make sure that users actually at some point don't lose confidence in synthetic assets, right? We provide that sort of level of security, that sort of assurance that they can invest in something new, yet at the same time they wouldn't get burned because there's certain things that hasn't been thought about. So I think this would be some of the key areas, and we have to be. I would say projects have to especially focus on, and users have to be careful about.
Lawrence, quickly, I want to add one quick thing, man. Here, I know I heard about your thing about hacks, man, and I think we really need, all of you will agree, better audit companies, man. Right? You try to get your contract audited, you know what you're getting into, man. Right? So I think we really need better audit companies who can do a lot better job than what they're doing now.
I think something that's also interesting is, we've always talked about a lot of. I don't think anyone, if you pull anyone off the street, I don't think I don't trust what we do here at all. But the crazy thing is, a lot of the CC systems are working, and the amount of value that's been traded here is insane. I think still people are under the impression that there is no liquidity in Bitcoin. Oh, I have 1 Bitcoin, I want to sell it. It's going to crash the market. No, it's not. Okay, you have 1 Bitcoin, it's nothing. Okay. Beyond that, something interesting that was recently brought up is that because of the whole coronavirus thing, and because we know like right now the US dollar is going like they're like 20% of US dollars just printed this year alone, right? That's the statistic I saw, and it's crazy, right? So everyone that I'm talking to right now, that it's like my friends that are non-crypto friends, they're like, we need to get out of the dollar, we need to get out of the US dollar, we need to get out of the Hong Kong dollar, buy gold. And they're all talking about ways to buy gold. I'm like, I just bring up my phone, I'm like, yo, I log into FTX, Face ID, log in, right? I go like XAUT, boom, I can click buy 3 like ounces of gold immediately, right? It just takes a second, and they're like, wow, what the hell, right? Like it's insane. It's like black magic to them, right? But that's not even the impressive part. I mean, if you're into DeFi and say I have like a coin, like I was talking about IOST with Lawrence earlier. If I have IOST and I'm using Ramp, then I can store that. I can use that. I can still generate stake with that, use that to extract value, get a synthetic token, move that to Ethereum, go to Unbound. I'm like, oh, yo, Unbound, I see you guys giving some good yield here. It's much better than HSBC's rate of 0.001% per year. I see a good rate. I'll deposit a token. Maybe I'll deposit this with some ETH USDT pair that I got from Lawrence, deposit down there, and then you give me another token. I'm like, okay, look, I got another stable coin. Let me go to Kevin. I'll dump that on Kevin's exchange. I'll be like, yo, I want to have some synthetic exposure to gold. I'm a newly minted gold bug now. So now I'm like, my one set of money is now doing like 3 things. I'm going to Lawrence's Ramp. I'm going to Unbound. I'm going to Kevin. I'm getting the gold exposure. I mean, that's crazy. And I think no one would understand this but us here. But I think in a few years, I think, people will start to understand it, because that's like a lot of power right there. And that's a lot of money too. So my 2 cents.
They can't ignore us, man. Not for long, actually, right? And you know, especially see, it's DeFi, right? For us, for me, actually, what DeFi is, when you build financial instrument on decentralized assets, that's DeFi, right? So, you have smart contracts, you're going to manipulate it, you're going to write algorithms to it, optimize your yields. This is, of course, money, 10.0 or something, right? So this is bound to happen.
Yeah, I think Tarun, I think your point is right. Is that there will be a lot of growth among the protocols, and there'll be a lot of financial engineering that will go on. And we'll get to a point where we will grow to a certain size in which we can't be ignored, right? And I have a deep feeling that at that point in time, that's when a lot of regulations obviously start coming into place, because we start bumping into people in traditional finance. We actually start disintermediating people like, as Michael said, people like HSBC, right? And they just won't be very happy about that, right? So I think that's something obviously we'll have to go ahead and handle going on in the future, particularly on the regulatory side. I think especially for synthetic assets, right? In a lot of countries, it's actually quite heavily regulated security in that sense.
But I think that the interesting thing, of course, is that regulations is good and bad, right? You want to protect people, but at the same time, it makes the barrier of entry very high. I mean, this is exactly why. I mean, have you ever tried to trade assets on HSBC? You'll realize how crazy the fees are, right? Like, you want to buy a share of something, a US stock. Oh, HSBC does that for you, but at $25 minimum, right? They'll charge you $25 and a percentage fee. Like if crypto exchanges did that, like, they would close down the next day because of just how high those rates are. So yes, sure, regulations are going to come, but I feel like regulations are set in a way so it's almost to guarantee protection for people. But kind of interesting in crypto is that because these contracts, so the smart contracts, they offer a predictability in what things are going to happen. I feel like that's where we actually need a new set of, say, so-called regulations. And I think at a deeper level still, I think like this is where it gets a little bit inaccessible. Like, we need to start understanding the code a little bit in a sense, but maybe either through audit companies or through a good explanation of how certain things go. I think it kind of avoids the need for heavy regulation in a sense, as long as because we can read the code, we know exactly what it's going to do, right? So long as, it's not broken, which is now, I think, our biggest challenge at the current point.
Mike, but very difficult, man. Go to any bank, right? See how many engineers they hire, man. Still, all of their tech is now outsourced to a tech company, man. They should have more engineers than bankers, man. What's going on, man, right? If they can't even do that, then how can they understand DeFi, man? Isn't it? So I think it's a long road, and again, all regulation needs to be tailor-made for us, for this system. Actually, it's something very new, which they cannot stop, but they keep on imposing their own existing frames and labyrinth on us, man, or on this space, which generally would fail. But I think except China, which know how to get engineers into their team, they have got the biggest guns. So
it's crazy. But yeah, I definitely agree with you.
It's a double-edged sword, right? Regulations, like at one point, on one hand, it constrains, yet on the other hand, it gives legitimacy. So it's kind of like we love it and hate it, depending on where you are at that point in time. It's a bit like, I would say, like Bitcoin. For a long time, Bitcoin was a scam. It's like a legitimate asset. Because we have legitimized it. There's some regulations around cryptocurrencies. There's structures that set up that allow typical investment funds, regulated funds to be investing, and suddenly it became something that is no longer a scam and is now a very widely covered investment even by the banks. So it's a good and a bad thing sometimes. I guess it depends on where we might be positioned at that point. But I would say if regulations do come into onto assets and stuff, it also may mean that synthetic assets, it also may mean that actually these products are starting to receive the attention of investors, of a wider base of investors, and it's actually a very good thing for all of us in the space, because it's just no longer a very small group of people playing around. It's actually being opened up to the rest of the world. Hopefully, there can be a balance between being overly regulated and actually allowing people that sort of access into the system.
Yeah,
These are really good points. When it comes to regulation, as we've been talking about, there is a balance of sorts, right? I mean, if we don't seek some form of regulation, then essentially we become outlaws, and then that's kind of where we do rely on those traditional on-ramps with the banks. As we've seen kind of with regulation in the States, even in India recently, we're seeing that banks are being given the license to allow for their customers to be able to open up accounts where they can actually hold their Bitcoin for them and then be able to use them for other purposes. When it comes to, and so there is a movement hopefully towards some kind of friendly regulation. When it comes to synthetics, which is obviously newer for us, we saw this year as well as I think last year with Abra in particular, right? They were trying to offer synthetic exposure to stocks, and initially there was a big problem because they're based out of they were based out of the United States. Their U.S. based users were all of a sudden being given access when they shouldn't be. The SEC started cracking down on them. They started to try to remove some of their business and place it in an international location, but still they had some exposure in the U.S. So again, it created problems. They weren't able to provide that exposure to stocks in this particular way. And so right now, they're trying to. I think we're trying to figure out how to kind of match with that regulation. Where is it that your business can operate from? If you're a centralized business, obviously, if you're purely decentralized, it becomes a bit of a different story, perhaps. But ultimately, it is trying to find. I think it's trying to find that synergy between if you're centralized, decentralized, and how do you actually operate with an existing regulatory space among all of these different countries. But that's part of, I think, what makes it pretty exciting. So, I guess these are some amazing answers. And so I think what I'll do now is let's shift over into some of the community questions that were asked. So the first one that here is, okay, we've talked a little bit about DeFi, but the question specifically is, how do the unique features of synthetic assets fit in with DeFi? So, again, I guess this is trying to clarify a little bit more about what exactly synthetic assets are and how do they actually fit into the whole current DeFi space.
Lawrence, you want to get it? Because you are right there, man. You want to say something?
Yeah, sure. Okay, I can. Yeah, I can have a first go at this. Yeah.
Go ahead.
So I think the DeFi space is interesting, right? Because takes its value from a certain underlying assets. In our case, it's a lot of crypto assets, and we actually allow all of these products to be created and controlled by code. So there's nobody doing up a form and approving a loan. Now you can go to a decentralized lending, and you can take a loan. You can do it in the form of you can do it just like this, right? Just by hitting a button on your computer. And then the next thing is that when it comes to synthetic assets, you'll be able to get into different exposures of different instruments or collateralize your assets into a derivative, a stable coin. Simply again by running, like basically depositing your assets and interacting with some code. So that's pretty crazy because right now there's no counterparty. You're just being involved in this whole P2P network that everyone agrees that okay, you have some value. That synthetic asset you have created is some value, and I think that's really interesting and powerful. That sort of decentralization, allowing everyone to come in and play, yet at the same time that level of financial innovation that allows such interactions to exist. I think this time of the year where synthetic assets, decentralized finance kind of just mesh up together into this very nice big team for 2020. It's quite really interesting times for all of us here right now.
Great.
Yeah, I think for DeFi, the creation of the synthetic assets actually essentially pushes us more so into the outer bounds, right? So if you look at the traditional financial markets, how did it start, right? Banks, right? Lending and borrowing, very similar to us, right? We had comp, right? But now with the creation of synthetic assets, we've pushed to the point where we can have things like insurance, essentially insurance products, right? Those are essentially synthetic assets. And you basically can buy and sell credit risk here and there. And in return, you can, for sellers, you can get a premium, right? We wouldn't be able to have those types of products, things like Nexus Mutual or the credit default swaps over at Aave, without having synthetic products right now.
Yeah, great. So Ken, let me explain this with taking an example from Unbound and explaining how that works and how that DeFi would seep into the synthetics part. So what you do with our platform is you would go and first provide liquidity on Uniswap or any of these AMM pools. Once you get the liquidity pool tokens from them, you bring them to us, you lock them in our smart contracts, again, decentralized. And once that happens, you are then given a choice to mint asset of your choice. You can then mint a stable coin or mint a pegged Ether, UEther on our platform. And tomorrow, maybe you can mint any synthetic asset of your choice. You can then maybe mint a Tesla stock or mint a gold token, right? And then add liquidity back to Uniswap or take it to a balancer, right? So all is so intervened that it's no longer that you can define boundaries, right? Where does synthetic asset start and where does DeFi end, actually, right? DeFi is enabling synthetic asset to exist, or synthetic assets is actually enabling DeFi to get more adoption. Is one of the same thing.
Yeah, and I think it's pretty much there. Like, it's the synthetic assets just give a way to represent a lot of DeFi tools. I think that's kind of the power here. So even just in your example that you gave, you go to Uniswap, maybe you have a USDC, USDT, so two stable coins. You drop them inside a pool, and now you get some Uniswap token. So yet again, that Uniswap token is now a synthetic asset. So you kind of use a tool, and this is like we give you a representation in DeFi of your tool, like of using this, right? So instead of going to a bank and getting a receipt, you get another token, and this token now can go to Unbound and get another token. So I kind of see like if you've been in space a long time, I feel like tokens are real. Like, so I get something tangible out of my actions. So I guess that's the helpful element there. It just kind of helps my thinking, and that's my take on it.
Okay, Mike, this reminds me of another example, man. Different analogy, right? That how advanced this whole space is. Because see, what happens in traditional assets, you can only synthesize or make synthetic assets out of another assets, actually. But here, you can even make synthetic asset out of actions. So there they have nouns, we have verbs here. What I'm trying to tell you is what is set protocol doing, actually. So now you can actually maybe own token which would represent a trading strategy on top of a decentralized asset itself. I think that's even a step further of synthesizing these assets, isn't it? So now you don't even have assets, but you have a trading strategy on top of assets, which are again now converted into ERC20 tokens, man. Right? I don't know how many more Legos we need to build, but this is pretty amazing.
This is Inception, man. This is Inception.
Yeah. I get that. Man.
Great way of putting it.
Within the yield, within the yield.
It is. So tomorrow we can have maybe, so this was thinking actually, let's say we may have, an index token, which would represent top 10, assets of the whole world, in such a fashion that each time one of the assets will fall below a 20% RSI, it will get rebalanced into this token. And, so we get better yields, as well as you're holding 8 or 9 top assets of the whole world with one ERC20 token, which is pretty much possible today, man. I'm not sure how many people are ready to buy it, but we can do this. Yeah.
I can build that if you want.
Okay.
Do it, man.
Perfect.
Great. So let me get to this next question here. So Ramp, this is specifically for you guys. We saw that Ramp DeFi has recently integrated Tomo Chain. What's your approach to empowering Tomo Chain holders with more investment options with synthetic assets, and how is it different from others?
Great question. So for us, it's really focused around the Tomo staking program, as well as how the structure of the staking program is set up. So essentially, we want Tomo users to be able to just be able to stake their Tomo and not have to worry about having to make any allocation decisions or anything. Just keep it staked, keep it inside, because after you keep it inside, will help you to generate a stable coin. from that asset, from that portfolio, and allow you to, whether it can be even be done natively within Tomo to transact, or brought over to Ethereum where you can exchange it for USDT and actually, go to say Binance to do trading, invest into new projects. And I think this is really good here because the key is that, you just maintain that Tomo exposure that you have always wanted to. Just because, you believe that Tomo price is going to rise, you believe that, you're going to make rewards, make good yield from the Tomo staking program. That's why you keep it there. You don't have to be choosing. You can have your cake and you can eat it. So that's where we're offering to Tomo users. And I think the key as well here is that the Tomo chain also has really good infrastructure, which I think, through our research and everything, we find it really, really amazing. So I think the key really is Tomo Bridge as well, that allowed Tomo tokens to be moving really easily between Tomo chain and Ethereum. Then I think this is where there's what we believe there's a positive feedback loop, because let's say you have $10 in Tomo, you don't have to be moving this $10 anywhere. You keep it there. You can bring part of this value over into Ethereum. You can generate earnings with it, and then you can bring it back into Tomo. So there's this value accretion that we believe that can happen for Tomo chain together with Ramp that drive greater value for everyone. Whether it's our users, Tomo users. Hopefully, this create more investment opportunities, options, ways that users can leverage their portfolios, stack different sort of use together. We'll be giving Ramp tokens as well to Tomo users who use our solution. So really looking forward to having it launch on the Tomo network very soon.
That's really cool, man. But yeah, I think it's a great example of kind of just for token holders in general, whether it's Tomo Chain or otherwise, what everyone has been talking about is just being able to take those tokens and utilize them in some other way. I mean, you're still having access to the exposure of the underlying token. At the same time, you're unlocking utility of that token as well. As you're saying, you can have your cake and eat it too. It's a good way of putting it. So let's move into the last question here. What do you guys think are the gaps to be filled in the synthetic asset space? What are the craziest future synthetic innovations that you can think of? I think we briefly mentioned one of them just recently, but what do you guys think?
I think I already spoke about the liquidation part, right? If you move forward than that, I think Oracle Digress and price feeds. I think these are the gaps which really need to be filled in a decentralized fashion, that we can easily use these feeds to generate more synthetic assets. So I think for me, my second gap would be getting better Oracle and price feeds for us to build more products on it.
Yeah, I think there needs to be more in the sense of due diligence, as well as I would say risk management tools for us to go ahead and actually assess and price synthetic assets correctly. Right. So if we're looking at things like credit default swaps, say for instance, so Aave created the first one off of Diversify, right? So with Diversify, there needs to be some type of mechanism or due diligence in there to tell people how much that credit default swap is worth. In the traditional markets, a lot of these are based on corporate bonds, right? Bond prices, bond ratings. But we don't have that in crypto yet. And until we do, and I think soon we'll have more and more research houses out. So people like Zangle or CrossAngle out in Korea who are looking into certain tokens, looking to companies, can come out with certain ratings, then we can actually price those correctly. Otherwise, it just seems like sometimes the DeFi just seems like we just kind of put our finger in there and figure out that, oh, that's what the yield should be and that's what the price should be worth, right? But in actuality, that shouldn't be the case. So in order for us to increase our sophistication, we need to have those tools and those risk management tools in place.
Kevin, on that, what do you feel about ARBs as a mechanism of this price discovery? Like what AMMs do, right? Put it on price and let's see how ARBs will reach out to the right price, arbitrages. What do you feel about it?
Yeah, look, that's right. I mean, price, if you're talking about price discovery, obviously, yes, the market can dictate the price, right? Mm-hmm. The way I'm looking at it is I'm talking about things like probabilities of default, right? Mm-hmm. So like I mentioned, in terms of credit default swaps, right? A part of that pricing is going to be the probability of default of the company. That's going to drive the premium that you should charge on the yields, right? Mm-hmm. And if you don't have those and people can't access it correctly, then I think the risk reward ratios are off.
Correct. But don't you think that the subprime crisis have taught us that rating system generally doesn't work, right? What do you feel?
Well, yes. I mean, I think that's definitely true. But it's either we have that or we don't have it. So you either have that or you have the Wild West of DeFi we're right now, right? So I mean, Michael can go and tell you that he's making like 800% off of this farm, but is that 800% correct? Like, I don't know. Like, do you know? Does Lawrence know? Like, is that correct? Like, I ask you, can you honestly tell me that that's the right risk reward ratio? Is that the right yield? Right?
So many questions, man. I wish
I think so. I think so. And I think like being more skeptical minded, I'm like, okay, look, we already have a great panel of some really guys who are doing some crazy stuff, right? So starting with Kevin, doing synthetic assets, creating them, just creating any sort of asset out there, right? Gold, oil, whatever, video games, esports. I saw esports on your thing. Like, okay, cool, esports, whatever. It really is the whatever it can create, right? Then we have Lawrence with Ramp connecting blockchains, providing value, extracting value that is thought to be locked on blockchains, and then you can now cross blockchain and extract value out of it. We have Tarun, basically, not only are you providing value to Uniswap, you can earn and get value out of Uniswap tokens. So I feel like we're already doing a lot, but I think we need some time to mature. I think a lot of this comes with time. So like that's the saddest part, right? We want to keep push the boundaries further, but I think like if you look at the past few months, like after the DeFi wave kind of died down a little bit, there's just a bunch of hacks, right? Because people just did really crap programming. It's a shame. It kind of brings DeFi, like it's a few bad apples kind of ruined a bunch in this current state. So we need more time to kind of eliminate the bad apples, or at least find the problems with these projects, and then kind of like make sure that the products that we're building right now perform the way that they should. And I think it takes a while, because like sometimes like we write code and we think it's all secure, but sometimes like some guy's gonna have a brainwave and feel like there's gonna be an exploit for this. And we previously discussed exploits, and we haven't had a big one that is true recently, but there has been in the past, right? Like the DAO hack, like that one was the one that rocked Ethereum, right? It was just such a badly written contract. Everyone thought it kind of worked, but then someone managed to find a way to empty all the money out of it, right? Like it's like you have a vault and then someone managed to drill backdoor. So you just kind of have to wait time to make sure that all these brilliant hacks and ideas and stuff, they've been tried and they cannot penetrate that vault. And I think this is the kind of the key here. We need to make sure that everything here is watertight before we take the next step forward. Now, I think we already have some pretty amazing stuff. So let's keep the amazing stuff amazing, and let's make sure it works. So that's my 2 cents.
Yeah, I do actually really agree with Michael. I think actually the whole DeFi and synthetic assets and the whole thing that's going on is really just a huge mining experiment. We are really building something, a financial ecosystem that's entirely out and different from what is in the current fiat markets right now. And I think as with everything, there's all sorts of different scams, hacks, and stuff. I guess banks make it a little harder for people to take money and run away. But a lot of all the things that happen in fiat, can happen in crypto. People being told to send money somewhere, getting your keys and all that sort of little things, right? And then us as sort of like people involved in this whole entire experiment, in a sense, we are also responsible for creating mechanisms, new interesting things like say, algorithms for like say prices for yields that, is able to provide that sort of market discovery, that sort of market stability, without really having say the rates being set by a middleman at the bank. Interest rates are set by the bank, but now maybe it's driven by algorithm and everybody are just really participants. There's no one really controlling anything, something that's entirely very different. We probably wouldn't be able to get everyone playing into it, but I think over time, I think there's probably going to be that possibility of 2 financial ecosystems developing, right? Like we are really here small right now, but some things is going to happen outside of the central fiat ecosystem, and we are going to coexist nicely with it. And the more bridges there are between it, the more seamlessly we integrate. And I think synthetic assets, DeFi will probably play a very big role in this whole this whole vision happening.
Lawrence, I agree with you, actually. I just want to add a few more things here, actually, right? Because security, right? Remember, I brought in that issue of audits right before this, right? Because it's not that we are broken. We are as an ecosystem or as as programming or everything. We are broken easily. Actually, it's just that we are evolving so quickly, I guess, that sometime what you do is gets outdated as before you can even put it in the market. Actually, right? That's a different story to have. We decompiled Uniswap contracts and we found out that there are different version of Solidity working with different version of Truffle, actually. So the space moves so quick, actually. And Solidity, the language which we actually program in, it's itself so innovative. It's more of a challenge to coordinate, than to actually, find a way that it get hacked, right? So what I'm trying to say is, the different versions comes up, different, evolution happen. I think that adds to the complexity of writing the secure contracts. And I think writing contracts is pretty easy, but finding a way that would sustain a test of time, I think that's where the challenge is.
Yeah, and I think to add to that too, I mean, everyone's talking about Uniswap V3. V3 is coming out. So whilst you're working on V2, V3 is going to be out, and you're going to be obsolete in a month. So I mean, that's definitely a huge challenge.
Yeah, true, man. I think, Mike, as far as we're concerned, until the liquidity stays in V2, we'll be very happy, man.
Who knows what's in V3? And the worst part is V3 is not even open source right now. They're not revealing any details about it, which is the worst part, right? So we can dream and maybe who knows, right? But good luck.
I guess in terms of kind of connecting us with the real world, obviously, as has been said, this has been one big experiment, and we keep pushing the boundaries. We don't have as many checks and balances in our system as you might have in the traditional space, because we aren't really regulated. And having that friction between blockchain crypto natives and the outside world, that gap of understanding what is Bitcoin, what's a wallet, what is a private key, how do I access all of this DeFi synthetic asset business inside, that friction in some ways allows us to innovate at this speed. Because we really don't have anyone to answer to but those who are willing to take the risks to participate in our space. So though obviously mainstream adoption is something we all want to attain, we are also kind of given a sandbox to experiment within, to move really fast, iterate really quickly, and yes, make others obsolete in a couple weeks flat. And we can continue, and we're able to criticize it. We're able to also accept the fact that, look, we lost money in something really stupid. There was a hole in the smart contract. It's shit, it sucks, but we got to move on. And that's just not something you can do if you're operating in a truly regulated ecosystem. So in some ways, I'm actually, pretty happy with the fact that there is that sort of that break, that harsh break where you really got to understand what's happening to be able to access it and utilize the space.
Can I ask a quick question for you guys? Do you think that we would be better off if we self-regulated ourselves and set up standards? I mean, if you right, because right now it seems like within DeFi, something bad happens, everybody says, "Oh, this sucks," and then we just kind of go off into our own space and keep continuing to work, right? So there's no punishment for people who are bad apples, right? And we all know that at some point in time, there needs to be, we're building a financial system, right? There needs to be safety for users. There has to be some type of rules and regulations kind of in place. No matter what people say, we can't be completely a Wild West type of a protocol or architectures at the end of the day, right?
Sorry, for some reason my video cut off, but I would say, maybe it's a sign, maybe it should remain anonymous, but the whole point of being anonymous and being on a blockchain means anyone can do anything. So even if the industry self-regulates, right? So what, right? You say it's not good. Okay, great. So someone's still gonna ape into the next Andre Cronje contract or some stupid shit like that, right? Like how are you, like it's hard to self-regulate. That's what I say, especially because it's kind of the core of crypto for us to be decentralized, and any form of regulation is centralization. So I don't know how we can cross that challenge. Like that's kind of like intrinsically wrong in a way.
We can self-regulate through smart contracts, man, right? Put smart contracts in, which would regulate few things, that's a possibility. But other than that, I totally agree. That's all centralization, man. And I think I would use that kind of self-regulation to maybe, get adoption from my project actually by going, outside that realm.
Yeah. I think it probably would be hard to regulate everyone because that's enforcement. But I think, say, self-regulation, I think in DeFi, I think simply the fact that all of us have came out here, show our faces, put our faces behind a project and say that we are building this, we are doing something, we are not going to rug pull. I think, that in itself would be part of the self-regulatory portion, people locking up their tokens, etc. So I think I would say, everyone out there who basically came out and backed the project on, with real identities, real faces, actually developing products, and being good actors would, if there is like a portal that actually covers all such projects only, that would be perfect, because I think it creates that sort of visibility for quality, hopefully. And I think that's something that would be very helpful and very much needed for both the projects and users. But of course, that there'll always be those guys as who just ape into the next one. is inevitable. People like to play that game. So I think it just ends up being a balance. But to be fair, I would like to see like somewhere even like some research houses, right, just having that list of projects where they even score people on how transparent, visible, and willing to be good actors in the system, and users actually checking that particular list and saying that, okay, like these are the projects that probably I would be best served to invest in, rather than just aping into the next new thing that just pops up, the next deflationary ABC.
Well, in some ways, the regulations in general, right, have come in traditional industries when it can impact a really sizable portion of the population in some capacity. In our space, I guess right now, in a way, it can be a little challenging to consider self-regulation, but the best way of essentially doing it, in a sense, is when projects come up, like you were just talking about, an ABC project, people jump into it and end up realizing that there's a problem, whether they've been rug pulled or there's an issue with the smart contract. Well, that money will flow somewhere else then. And typically it's going to go to whether you're getting the highest yield, but hopefully also it's a risk reward scenario, highest yield, and hopefully with smart contract that, hey, has been built off of something else that has been tested and broken and fixed, and it continues to iterate on that in that way. Money will then flow into where they can get that best risk to reward ratio. But right now, yeah, transparency is a bit of a problem because not everyone can read a smart contract. People are just willing to just jump into whatever, hoping to reach that alpha. But that's, so I think for the time being, I agree, it may be a little difficult to do self-regulation, but money's going to go where it feels that it can get that best risk reward ratio for sure. And that's probably what's going to happen for the foreseeable future when it comes to internal within our blockchain space. That's how I'm looking at it. All right, guys. Well, this was an amazing hour with each of you. This was, it was like, I felt like I was earning my master's or PhD right here. I mean, each of you just came in with so much amazing knowledge. So I really appreciate the fact that, that we had each of you joining with this latest episode of Defining DeFi. I mean, it's been amazing. And, so I want to thank each of you. And also I hope that, and I'm sure that, everyone that's watching this has also taken something away from it. Synthetic assets is it's not a brand new space, but it's something that's been developing for quite a long time. But now it's really being expanded upon, and I think each of the people here are tremendous leaders in their own respect. So thank you again for joining us, guys, and we'll see you again hopefully next time on some other panel, in some other event together.
Thank you. Thank you, Ken.
Thanks, guys.
Thank you.
Thanks, Ken.
Thank you. Thank you. Cheers.